The United States is a popular destination for foreign entrepreneurs and investors looking to start or expand a business. However, foreign-owned U.S. businesses face unique tax obligations that require careful planning and compliance. Understanding U.S. tax rules is, really essential for anyone considering doing business here. A foreign-owned U.S. business is any business entity operating in the United States that is partially or wholly owned by a non-U.S. person. This includes U.S. corporations, LLCs, and partnerships with foreign owners, as well as foreign companies doing business in the U.S. Even if the business has limited activity, specific filing and reporting rules still apply. Foreign-owned U.S. businesses are subject to U.S. federal income tax on income that is effectively connected to a U.S. trade or business. C corporations pay corporate tax at a 21% flat rate on net taxable income. LLCs and partnerships generally pass income through to owners, but withholding taxes may apply for foreign partners. S corporations generally cannot have non-U.S. shareholders. Income sourced outside the U.S. may not be taxable, depending on tax treaties and business structure. The IRS requires U.S. businesses to withhold taxes on certain payments made to foreign owners, including dividends, interest, royalties, and certain profit distributions. The standard withholding rate is 30%, unless reduced by an applicable tax treaty between the U.S. and the owner's home country. Failure to withhold properly can result in significant penalties. Foreign-owned businesses have some additional reporting obligations that you need to be aware of. These include Form 5472, which is required when a U.S. company is at least 25% foreign-owned and engages in transactions with foreign owners or related parties. You'll also need to file Form 1120, even if the company has no income, just to submit Form 5472. For partnerships with foreign partners, Form 1065 and Schedule K1 are necessary. And don't forget about Form W8-BEN or W8-BEN-E, which identifies foreign ownership and determines withholding rates. Penalties for missing or incorrect filings can actually exceed $25,000 per occurrence, so it's really important to get this right. In addition to federal rules, foreign-owned businesses must also comply with state income taxes, sales taxes, and nexus laws. Operating or selling in a state may trigger filing requirements and, e-commerce businesses might owe sales tax under economic nexus rules. Multi-state compliance definitely adds another layer of complexity to your tax obligations. The U.S. maintains tax treaties with many countries to prevent double taxation and reduce withholding rates. Transfer pricing rules require that transactions between U.S. and foreign affiliates are priced fairly and documented properly. Incorrect pricing or documentation will trigger IRS audits, so it's crucial to pay attention to these details. Foreign-owned U.S. businesses face strict tax rules and reporting obligations that, honestly, differ quite a bit from domestic companies. Proper planning, accurate filings, and treaty analysis are essential to stay compliant and protect your investment. At SK Tax Associates, we specialize in helping foreign entrepreneurs navigate U.S. tax laws, compliance filings, and withholding requirements. Contact SK Tax Associates today for expert guidance on managing taxes for your foreign-owned U.S. business.